All three major averages inching higher today as Wall Street awaits NVIDIA's earnings tomorrow. Let's bring in our market panel. Vital Knowledge founder Adam Crisafulli and Stifel chief equity strategist Barry Bannister. Guys, welcome. Adam, I guess a bear conversion happening in the markets now. Are we running out of reasons for the major indices to head higher than this? Is there fewer maybe betting against it? Or is Microsoft's record high here on AI news a good sign?
No, it's definitely, tech's doing a lot of the heavy lifting. We've had, for the last 2 weeks now, several very positive, bullish AI product events that's helping keep enthusiasm for that segment of the market very strong. So you had OpenAI and Google last week. You had 2 days now of Microsoft events. And like you just said, we have NVIDIA tomorrow. So, the AI corner of the market is doing a ton of heavy lifting, and that's still working. I think the fundamentals are still relatively supportive, but technical conditions have moved in a less favorable direction, just as far as sentiment and positioning, et cetera, in the last month, given the degree of the rally and how many people have been dragged in. So that part is less supportive. Fundamentals are still relatively healthy, but the setup is not nearly as positive as it was, even just a couple of weeks ago.
And Barry, you're ready to say it's over. I mean, you're saying we're going to get a full 10% drop in the S&P in the next 4 months. If so, what triggers it?
We're looking at sticky inflation, a lot closer to 3% than 2%, which is the Fed's goal. And we're thinking the economy is actually doing just fine. It's recovering from what was a de facto recession in mid-22 to mid-23. The market foresaw that, peaking on December 30th of 21 and falling 32% in real terms in 10 months. So after that pseudo-recession, we're getting the recovery. We've harvested all of the disinflation late cycle that you would expect after such a slowdown. And now inflation will pick up in the second half, and it'll certainly delay Fed rate cuts and maybe even change their views on what normalized interest rates should be.
It's interesting, Barry, because we have made a lot of hay about the fact that Mike Wilson over at Morgan Stanley has changed his call, and this idea that it's left Marko Kolanovic over at JPM is sort of the last standing bear on Wall Street. But you sound kind of bearish yourself.
Well, we're very tactical. We look at everything in about 6-month increments. I can tell you from experience in the last 40 years that turning bullish in May seasonally is a very dangerous game. It didn't work when I was an analyst for 25 years. Every bad call I ever made was turning bullish in May or bearish in October. So I would be a little skeptical of a bullish conversion in May at this point in time. But in our tactical call, based on macro, we're looking for a pullback in the market. It doesn't mean it can never rise again. It just means that we're looking for a correction.
Adam, I want to get your thoughts on the flurry of Fed speak we've gotten, especially as we get the minutes tomorrow. It does seem like the message has been pretty clear and pretty steadfast from the many officials we've heard from, yet Waller perhaps getting the most attention, in part because, not because of what he had to say about needing several more months of good inflation data, but perhaps about what he has to say about the economy cooling. I want to get your thoughts on that.
Yeah, I thought the most interesting part of his speech today was that there was, a substantial part of the text was focused on indications of slowdown in growth. He noted the ISMs, both ISMs are below 50. He noted the recent cooling in retail sales, and then also some of the labor numbers as well are kind of coming off the boil. I think the Fed is speaking from a relatively consistent script. The bar for incremental hikes is extremely high, very unlikely to be reached. They are not comfortable with, talking about rate cuts in the immediate term. And the market isn't pricing that in either. So there isn't a real discrepancy in that front. The market's looking at September for the first cut and only about 1.5 cuts for this year. So there aren't aggressive cuts being priced in. So the market and the Fed are on somewhat of the same page. I don't think that the risks of the market really are inflation on the upside. I think the risks more are growth on the downside, because you have had now several weeks of downside data on manufacturing, on services, on labor, on retail sales. So to the extent that continues, I think that's really where the risk to the current narrative lies. It isn't so much on upside inflation risk.